Good afternoon and welcome. I'm Reena Agarwal, Robert E. McDonough Professor of Finance and Director of the Georgetown Pissarro Center for Financial Markets and Policy. It's a pleasure to open today's webinar hosted by the Pissarro Center, where we'll explore key risks and uncertainties shaping the financial markets today. At the Georgetown Pissarro Center, we are committed to providing objective, research-driven expertise to support both policymakers and market participants. Amidst the vast array of information available, we offer a unique value as an intellectually honest broker, a facilitator, and educator for practitioners, policymakers, and the broader community. Our impact extends beyond the financial sector. It resonates throughout the global community because a well-functioning financial sector is crucial for job creation, for innovation, and for addressing complex global issues. The Georgetown Pissarro Center is a leading authority in unbiased expertise at the intersection of global finance and policy. Today, we are honored to be joined by two exceptionally distinguished speakers who bring expertise and insight to today's conversation. Joe Amato, president of Neuberger Berman and a dedicated member of Georgetown University's Board of Directors and the Pissarro Center Board of Advisors and a Georgetown alum. Lael Brainard, our Pissarro Center Distinguished Fellow, former director of the White House National Economic Council, and also former vice chair of the Federal Reserve Board and undersecretary of the U.S. Department of the Treasury. Guiding today's discussion is Nick Timiraos, chief economics correspondent at the Wall Street Journal and also a Hoyer. It's a true privilege to have Lael Brainard and Joe Amato with us for what promises to be a thoughtful and timely dialogue. Our discussion today will examine how investors and institutions are navigating inflation, shifts in monetary and fiscal policy, and disruptions linked to trade and tariffs. The goal of today's event is to foster a deeper understanding of these complex issues and spark meaningful conversation on these very topical matters. I encourage you to visit the Pissarro Center website and social media channels for further information about the center, including our upcoming Financial Markets Conference on September 25th. Thank you for joining us. And with that, I'll turn it over to Nick to begin the discussion.
Thanks so much, Reena. And Lael and Joe, it's great to be with you today for this conversation. I feel like it's a good time to be doing this. If we had done this 3 months ago, even though there's a lot we don't know today, there have been some more policy blanks that have filled in. And so I want to start with the news this morning from the June Consumer Price Index report and inflation. There's been, of course, some concern that finished goods prices would rise on account of the tariff increases that took effect earlier this year. Some people will point to the June CPI this morning to say, well, maybe this isn't going to be as bad as feared. Lael, I want to start with you. What's your assessment, taking both what we've seen now in the data for the first half of the year on inflation? What do you see going forward? Is the softness on the demand side of the economy possibly because we still have tight monetary policy going to prevent the pass-through to higher prices? Or is this something that might be of greater concern for people who have to worry about inflation risks?
Well, good afternoon, and thanks. Nice to see you, Joe, and Nick. Thank you, Reena. Look, I think this morning's data on CPI overall looked pretty benign. But markets, I think, responded with some real wariness, because if you look underneath the hood, you are starting to see those tariff effects showing through. On the one hand, core goods looked pretty good, but that's because you got the used cars, which we expected to be coming in quite soft for seasonals and other reasons, masking increases in areas that are being affected by tariffs. So appliances, apparel, toys, footwear, all of those areas are areas that are likely to be showing tariff effects, and they're starting to do that. And of course, the tariff rates still aren't set. They're going up, not down, in terms of the announcements that we've been seeing. And so it does suggest that we've got to still wait for a few more inflation prints before getting a real sense of how inflation is going to be affected by tariffs. I think the one other question you asked is, how are those tariff increases going to be divided between consumers seeing higher prices and businesses having to compress margins? Right now, you're probably seeing a little of both. Small businesses, of course, are going to have to be passing tariffs along, and larger businesses might be able to take some of it in margins for a period of time. But ultimately, I think we are expecting to see tariffs showing up in prices. And these are large tariff increases. Let me just wrap up by saying that we're talking five-fold increases in average weighted tariffs across the economy. So they are quite significant, even if we held at the more benign tariffs that we were hearing about a week ago.
Lael, I want to follow up with you on that. The broad question I hear from people, including in the administration, they say, well, this is just a one-time increase in prices. And the question that comes up is, well, what is going to nourish a one-time increase in prices to become inflationary beyond that one time? So I know the Fed feels burned by the transitory description in 2021, but what is going to sustain inflation today, given that labor markets don't seem to be terribly out of balance? The housing market doesn't look anything like it did 4 years ago. Energy prices are not on the upswing. And if those things are true, what is it that policymakers have to worry about if this is just a one-time increase in goods prices?
I would probably be in that camp of thinking that in the absence of real strength among consumers, that we might see prices bump up and not lead to a sustained increase in inflation. But a few things might be holding Fed policymakers back. First of all, inflation expectations are not as well anchored as they were a few years ago, simply because we have had an experience of high inflation caused by the pandemic. And you can see that in some of the consumer surveys. And so there is a concern to make sure that inflation expectations are well anchored. That's what ultimately will keep the tariff effect from becoming sustained. The second thing is, don't forget that people will be getting refunds early in the next year from the mega law that just passed. Those are very significant increases. And so we'll see a little bit of uplift in consumers, particularly higher end consumers, as those start to take effect. And then the third thing that people might be a little concerned about is that labor supply is going to be tighter because of the very significant change in immigration policy. And so those three things together might lead to greater caution, greater concern about just caution about a potential inflationary impetus from these tariff increases.
Thanks, Lael. Joe, I want to bring you in on this. The market today, there wasn't a dramatic reaction, but we did see a little bit of a sell-off in the bond market. What do you think explains, a relatively benign, at least, the headline number on core inflation wasn't terrible. What do you think explains maybe some of the concern, if you can call it that, from the bond market?
Well, I would echo certainly what Lael said earlier. I think the number overall seemed relatively benign. You look at the internals; they look a little more challenging in some of the areas that would be subject to higher levels of tariffs. Right? You think about furnishings, home furnishings, or apparel. Right? There were decent jumps in inflation there, so I think there's some wariness in the bond market as it relates to that. At the same time, you sort of combine it with a topic I'm sure we'll get to, which is still the noise around the administration and the Fed. And I think that's probably what's more destabilizing on the long end of the market, at least what, as we've talked about things here internally at Neuberger today, that's more of a focus on the long end. And, we, from a positioning standpoint, have really stayed away from the long end for a whole variety of reasons, which we can go back and talk about, and have stayed more in the sort of the belly of the curve, and because of some of the longer term concerns.
So Joe, we saw a pretty remarkable sell-off right after the tariff increases were announced in early April, then a rebound as the president retreated. The flip side of this argument that there isn't going to be a lot of inflation is that it could be pretty tough on margins on retailers. And yet we've seen stocks hold their ground here. What do you think explains that dynamic? What do the markets see that some of the forecasters that I talk to who are much more worried about downside risks, what explains maybe some of that disconnect?
Well, I think you had, after the initial shock of the tariff announcements that were well in excess of what anybody seriously considered, you've had a surprisingly resilient economy. So the economic hard data, the soft data has been all over the place, sort of more survey oriented stuff, but the hard data has hung in there pretty well. You've had a pullback from a tariff standpoint, right? A pause, an extension, a sense that the administration won't necessarily go full throttle to the extent of the April 2nd announcements. And then thirdly, earnings have held in okay. First quarter earnings were pretty strong, actually, in the U.S. markets, S&P 500 in particular. So a combination of those have sort of allowed the market to bounce back. And I think there's certainly lots of us who are looking through some of the shorter term noise to say, what are the longer term issues here? What does the long-term earnings picture look like? How might some of the policies that maybe are more pro-business, how might some of the policies that relate to deregulation affect the support for the longer-term economic growth after you get this sort of short-term disruption from the shock of the tariff situation?
And then we've seen, Joe, the president threatening new tariffs. I guess we've extended now the July 9 deadline to August 1. But the president's also talking about increasing tariff rates from what he had put out on April 2. Are markets thinking this is less of a worry because the president has shown he's ready and willing to back off, that he wants to make deals? It doesn't feel as if it feels as if people are sort of getting used to this. What do you think explains some of the sentiment adjustment that we see versus the latest round of tariff posturing versus what was happening in April?
I do, Nick, think that there's a level of complacency out there. I think there's a sense that the president's going to pull back, or the administration is going to pull back on some of the worst of the tariff policies if there's more noise in the markets. It's almost it's an interesting conundrum you find. The markets need to pull back for the president to pull back, and you're not sure who's going to blink first. But I think that with markets bouncing back the full way, right? We're worried about the short term, right? That there's an expectation here that, well, we're going to cut it, we're going to get deals cut, we're going to either extend pauses, we're not going to have the full extent of it. And our sense is that the administration, the president in particular, is getting frustrated that there hasn't been more progress on deals being announced. And as most people probably appreciate, right, these trade deals are complex negotiations. Often they take a year or two to work through. And the notion that you're going to get through 90 deals in 90 days or this number in a short-term amount of time is just an unrealistic expectation. Now, might there be a framework like we saw to the UK? We get through Japanese elections. Might you see a deal with one of our strong trading partners in Japan? Probably, but the market has a lot of optimistic expectations as to what's going to play out here over the next couple of months.
Yeah, 90 deals in 90 days sort of reminds me of we're going to cut $2 trillion of spending right off the bat with waste and abuse. Anybody who's looked at the federal fiscal have a different view on that. Lael, I want to, you touched on some of this in your last answer. We're running multiple policy experiments here, not just on trade, but as you noted, on immigration and on fiscal. If you were in your old seat at the Fed, how would you be thinking about whether the Fed could, in fact, resume the rate cuts that your former colleagues paused really at the beginning of this year?
I do think that, as Joe was saying, that the lack of a landing zone on tariffs is really problematic. The administration seems, at the end of the day, like they are trying to hit revenue targets. And so that is what it seems to be driving these very high tariff rates, along with a whole host of very particular issues, going to even political issues in places like Brazil. So hard to see exactly what the underlying formula is, but the one theme that I hear a lot is this need to hit certain revenue targets with tariffs, which means the tariffs aren't going to get much lower than 15% weighted average tariff. And again, five-fold increase, that's an enormous change. So big policy experiment. Another policy experiment, as you said, $4 trillion addition to the national debt for the mega law, which includes tax cuts and some increases in spending in areas like immigration and defense, and some cuts in the area of Medicaid. So we'll see also how that plays out. Now, those tax cuts come soon, and the Medicaid cuts that are going to hurt low-income consumers come after the midterms. So that might play out on a slower trajectory, but big change in immigration policy. And of course, we're seeing that hitting areas which do traditionally rely quite heavily on foreign-born workers, including the agricultural sector. And that's going to have potential impacts on food prices, hospitality, residential construction. Those are all areas where prices were already high. And so if we do see real labor constraints there, I do worry that we are going to also see that affecting consumers' purchasing power. So all of those things together, I think, create some uncertainty for the Federal Reserve. That said, my own sense is they are restrictive and they do have room to cut, that their plans that they put in their summary of economic projections look quite reasonable to me, that we might see a cut as soon as September and potentially two cuts by the end of the year. That does seem like, given that the inflation data is likely to be impacted over several months rather than seeing, a big surge in inflation early on, they will have some room to fulfill those plans.
I want to pick up on the conversation of the neutral interest rate, because there was a little bit of a debate about this last year, whether the neutral interest rate has shifted higher. There's one view that that I hear quite a bit. Rates are still restrictive because no one really thinks a 2% real rate is a neutral rate today. But I do hear some dissenting voices outside the Fed who say, well, the economy has maintained growth around trend, unemployment around the natural rate, with inflation just a little bit above its target. Why might, what is there to say that the neutral rate isn't quite a bit higher than it was in the period between the financial crisis and the pandemic? How do you see this aspect of the debate?
So it's certainly the case that the neutral rate could be higher than it was pre-pandemic. There are good reasons to think it might be both fiscal and because we may actually be getting a sustained increase in productivity from AI. I would anticipate that, in fact, AI is that significant, and we are going to see it diffuse out into the economy and lead to higher productivity over time. Now, obviously, the economy had been growing quite well, as you said, with a very strong labor market, but that's less true in the first quarter. I see a weaker consumer and certainly a much softer labor market. So, my sense is that restrictive nature of current rates, it is probably acting as a little bit of a drag. Certainly, some combination of that and concern about tariffs is weighing on consumers. Income growth, real income growth, is not as strong as it was before. If you look at the labor market reports, we'll see on Thursday what happens with retail spending. But my sense is it's been a little weak, and I expect it to remain so.
Joe, same basic question to you. Do you think interest rates are tight right now? Some people tell me, well, financial conditions outside of the housing market don't look particularly restrictive. Is this an economy that is making that adjustment to a higher level of rate after what might have felt like an unnaturally low rate during the previous decade?
So I think the neutral rate is a little bit of a price discovery process, and I don't envy central bankers that have to try to figure out what the neutral rate is, because there's so many factors that go into what's actually driving economic activity, right? Last year, GDP in the U.S. was roughly 2.5% positive growth, right? This year, our expectation that number is going to be in the 1.5 range. So the economy is slowing down. With the inflation levels that we talked about, whether you look at headline or core, based on the growth rate and inflation, there's room to cut, right? Our expectation is the Fed's going to cut a couple times this year, consistent with what Lael referenced. And that's part of a little bit of our longer term optimism, right? You've already seen the Fed cut rates so far, right? You had some impact from that, right? The cuts that were previously done. But I think there's room to go there. And even if you expect inflation to remain at the levels that we're currently sort of, stumbling at, if you will, we think there's room.
I want to ask you also about debt sustainability, Joe. The question some people pose to me somewhat flippantly is, what does the 10-year bond have to do, the 10-year note have to do to get to the attention of policymakers in Washington? But it's a fair point. Deficit concerns just haven't been on the radar of late. 15 years ago, there was, everybody had a deficit reducing commission at a time when aggregate demand was pretty weak. Today, we've had higher rates, somewhat better growth. What has to happen in your view to get that conversation re-engaged, or does it need to be re-engaged? Maybe the framing of my question is all wrong and it doesn't need to be, but what would need to happen if you wanted to see that conversation take place?
Well, I think if you the long-term deficits are the biggest concern that we have as we think about the outlook for the U.S. economy, financial markets. These things are not a problem until they're a problem, right? You can ask Liz Truss, the former UK Prime Minister, about that, where all of a sudden, things explode and you almost take down the entire pension system because the UK gilt market exploded. So it's not a problem until it becomes a problem, but we're heading toward a problem. I think if you see the 10-year above 5%, I think you're getting a lot of attention from, and I think that's the level that equity market folks will start to get concerned, right? We're close, right? The 30 years already there, or at least it was a short while ago. So we're wary of the long end, and I think you have deficits that in the next few years are actually going, depending on the level of economic growth, may increase because the bill that just got passed, right, is going to be fiscally stimulative in the first few years, with the deficit reduction occurring 2030, 31, 32, et cetera, right? So you're getting the front load, which was the plan, right? The front load stimulus and the back end deficit reduction. I'm not going to hold my breath waiting for the back end deficit reduction because lots of stuff's going to happen before we get to 2030. And those deficits running at 7%, even if you include tariff revenue. So tariff revenues right now, U.S. imports roughly $3 trillion of goods. So if you have a tariff rate of 10%, 10, low teens, whatever, you're going to be 300 billion plus in tariff revenues. How sustainable that is long term, big important question, right? Do they get unwound in the future? I don't think they will. I think even a new administration, even a Democratic administration, is not going to cut back. I would be shocked if they cut tariffs below the 10% baseline reciprocity rate. So, the challenge you have right now is you've got to generate higher levels of growth, right? You've got to get your nominal growth up to deal with the tariff. That to me is the only realistic way I can envision us chipping away at a deficit. I'm not particularly optimistic, all due respect to Washington insiders. I'm not, I don't have an expectation that there's going to be a lot of deficit reduction spending cuts. If you look at the big buckets, as we all know, of where the money's spent, whether it's interest expense, which you can't really control, right? Defense and entitlements, it's not very optimistic outlook.
Well, we've seen a pattern, I think, where you pass the tax cut and you sort of it's not a long run tax cut, so tax rates kick up at some point in the future, and you dare people not to allow that increase to happen. No tax on tips, for example, I could see it being very difficult for both political parties to support. Well, now you're going to raise taxes on wage earners who get tip income. So, Lael, I'd put the same question to you. I mean, during the Obama administration, there was a willingness to talk about spending cuts, tax increases, coming up with a plan. That's faded for the last, I would think, 10 years. We haven't really heard much. What do you think it's going to take, to the extent that you agree that this, is going to be a problem at some point? What is it going to take? What is going to animate that discussion?
I certainly completely share Joe's view that fiscal sustainability is our biggest federal fiscal challenge, and there is not a real forcing event. Ultimately, the market is the disciplining device, and it's just extremely unpredictable exactly how and when that disciplining device kicks in. But what we know is, as you noted, Nick, that we see this pattern of putting in place tax cuts that reduce revenue below the long-term average. And then, that we know that we have an aging population. Those entitlements actually mean that spending on entitlements is going to go up relative to the long-term average. There's no real give on defense. Discretionary is kind of frozen in place. There's not a lot of ability to cut there. That's not been the part that's been growing. And so, of course, interest expense is growing. So that's a real problem. Now, the one thing I will say is, in this environment, we do as a country benefit enormously from the fact that the dollar is a global currency. It means that we not only borrow in our own currency, but we save money every year because people are willing to invest in treasuries at lower rates than they would for other countries around the world. And that's, some people estimate it's on the order of $150 billion of interest costs a year just in terms of foreigners holding our debt. It could be a multiple of that if you take into account the rate advantage, what is called the convenience yield, more broadly. And so my concern right now is, at a time where this administration has supported adding $4 trillion to the national debt, they seem to also not be taking very seriously the key underpinnings that give us that privilege of borrowing internationally at a lower rate in our own currency. And so when they go after the independence of the Federal Reserve, when they basically undercut a lot of international agreements by unilaterally imposing very, very high tariffs on countries that are actually playing by the rules and are our allies and partners, that over time they might erode that privilege, and that will cost us. It will cost us more to service our debt every year, and it will raise the possibility that we get some kind of adverse reaction in the market. So I do worry about that.
Well, Joe, let me ask you. I mean, we don't have any, history of this, but what would happen in the market specifically if the president tried to replace the Fed chair? If he announces on Truth Social, I've asked Jay Powell to, stand down, I'm firing him for cause. I don't know, how likely this is to happen, but what impact would that have? How do you think markets would respond to something like that?
Bad and poorly. I think it would be awful. A lot of volatility on the long end of the curve, I would anticipate. One of the strengths of our system, to state the obvious thing that I'm sure everyone on this webinar would agree with, is the independence of our institutions. Look at any country around the world that has weak independent central bank, and it doesn't end well. So anything that chips away at that, we think is a very, very bad idea. Markets are resilient, so they'll probably at some point refocus on, okay, who's going to be the Fed chair, and is that person going to have policies that are consistent with sustainable long-term growth and disciplined monetary policy? And that of course is a big open question, and there's been lots of debates about who's out there. We know some of those folks really well and think very highly of folks who've been publicly under consideration here. But a sloppy process here, whether it's a shadow Fed chair where you've got somebody looking over one shoulder, is a terrible idea. I don't know why anybody would want that job anyway. But I hope it doesn't come to that. I hope this is a case of just kind of chirping at the referee, to try to influence a bit on the margin, but without actually doing anything more severe than that.
You're right. I mean, this is an institutional arrangement that's developed over the last 50 years. It's not in the Constitution, not in the law. I imagine Lael I don't want to put you on the spot. I think every president probably has wanted lower interest rates at some point. I have to think there were times last year in the Biden administration when people were saying, not you, Lael, but come on, let's get on with this. Inflation's come down a lot. My point is every president has wanted low rates. Lael, what would it mean for the U.S. economy if we don't have this relationship anymore, the one that's developed really since the Volcker years, where people can criticize the Fed, put pressure on the Fed, but you don't really try to have a president grabbing the steering wheel of monetary policy outside of the traditional appointment and confirmation process?
Look, I think that it would be extremely dangerous. The reason that people believe that investing in Treasury securities is the safe investment, the reason they're called safe assets, is because people believe we have an institutional environment, and we have shown we have an institutional environment that controls inflation effectively. And that in turn means the value of their investments hold over time. The dollar has remained relatively strong over a long period of time. And so those two things together mean that it's a really good thing to invest in Treasury securities. You can feel like that truly is the safe asset. It is used in as collateral for financial transactions all over the world because Treasuries hold their value. Now, if you see a change in that institutional environment, which means that the Federal Reserve becomes subordinate to the president, to the administration, you could see that instead of fighting inflation being the primary goal, keeping payments down on the national debt becomes the primary goal, right? So we've seen the president say this. He's very frustrated with the Federal Reserve, with the chair in particular. He said if he would just lower rates to 1 percentage point, which means a reduction of about 3 percentage points, that will save us $1 trillion in interest rate payments. That is a very unusual statement, and it suggests that he wants a Federal Reserve chair that is going to first and foremost focus on Treasury debt management. That is what we saw in the wake of World War II, and it led to very high inflation in those post-war years until the Treasury and the Fed got together and they agreed on the Treasury Fed Accord of 1951. And everybody agrees that was a critical step in giving the Federal Reserve that independence and the perception of independence to put fighting inflation first. And so I do worry that this pressure campaign against the Federal Reserve chair and the rhetoric suggesting that the Federal Reserve should be more aligned with reducing rates for the administration does chip away at that independence and therefore at the credibility on inflation control.
I think Joe alluded to this in one of his answers, that the market hasn't reacted more because they have some confidence in the institution here to operate as it normally has. But Lael, I want to ask you, you were at the Fed for a long time, 9 years, you were the vice chair. How easy would it be over a 4-year term to change the culture of this particular institution?
Well, there's a few things that are important, but of course, first and foremost, the chair does have very important authority within the Federal Reserve System. The Federal Reserve Chair really is the person, the FOMC chair and the Federal Reserve Chair. That one position puts forward the recommendations for monetary policy and is the kind of driving force for changes to the framework that governs monetary policy, that prioritizes inflation fighting and full employment, for instance. So that person matters a lot. The second thing, though, which I think you're alluding to, is, of course, monetary policy is voted on by a committee. And within that committee, the board, all members of the board have a vote every time. And so having a majority of the board members is also very important. And so you're hearing now increasingly these statements suggesting that not only is the president eager to see the end of the Federal Reserve Chair's term, but now we're hearing that they are hoping that the chair will also step down from the Board of Governors, because only by doing that will you actually see 4 members of the board being current Trump appointees. And so you're seeing this additional pressure starting to build because the chair's term as chair ends in May 2026, but he is a governor until January of 2028. So it wouldn't be until that point that this administration would have the opportunity to actually change the majority on the board.
So I have to ask about this brouhaha over the Fed buildings, because I'm sure you have some experience with this. These are 3 buildings the Fed has been renovating. It's a big price tag, and the White House has been accusing the Fed chair of I think they've been accusing him of mismanagement by making a big deal of this. So I don't know if this is a pretext to make a for-cause removal. As you alluded to, maybe it's an effort to make life so unpleasant for the chair that he gives them his seat when he leaves. Can you explain what you see happening here? What is your read on this recent controversy? I don't know if that's the right word, but political noise around this building project, which began 7-8 years ago.
First, I think it is important that the Federal Reserve is a public institution. It is responsible for carefully stewarding its expenditures and its resources and being fully transparent and accountable to the public on those expenditures. And so that is the first important thing. And they are subject to oversight by Congress. They have a Inspector General who undertakes oversight of the board. And of course, the board itself, as we were just saying, it's a 7-member institution. And so the board has to vote, the entire board has to vote on every budget every year that would include the capital budget for buildings. So I presume that there is already a lot of internal oversight and process that has made sure that all of those expenditures are transparently disclosed and carefully stewarded. But more generally, coming as it does at this time where there's just immense pressure coming from the White House and a lot of allies in and around this administration on the Federal Reserve Chair, it does seem like a pressure campaign. And it is, I just haven't seen anything like this. It is really quite unprecedented. To me, it's very troubling because the Federal Reserve's independence has just been such an important part of what makes the U.S. financial system so strong and regarded so favorably by investors all around the world.
Thanks, Lael. We're almost up against our time here, but before we wrap up, I know we haven't talked a lot about international. I was going to ask both of you, and Joe, I'll have you go first. What are the top risks you see right now facing the U.S. economy or the global economy? Maybe we've already covered it here, but what are the things that keep you up at night when you think about, where this country is 5 years from now, where the economy is 5 years from now?
Well, I think we've touched on them. I think in the short term, it's the disruptions caused by tariff policies, right? You're talking about a complex, enormous global trading system that's been given a bit of a shock, and and interestingly, right, the U.S. is fighting every one of its trading partners, where each individual company is, or other country is fighting one trading partner, right? So it's actually in aggregate more painful for the U.S. when you think about it broadly. So in the near term, the disruptions associated with that. Longer term, it goes back to the deficit and really from a financial market standpoint, the risk of the long end of the curve being unanchored, right? You have an unanchored long end of the curve, and there's going to be a lot of bad days, in markets, and it has the downstream effect of whether it's mortgage rates, consumer lending rates, other parts of the real economy, if you will, that would be affected by a significant movement upward of long-term rates. So as much as there's this enormous focus on short-term Fed policy, right, it's really longer-term rates that are so important to financial markets and to the real economy.
Thanks, Joe. I'll give Lael the last word on that same question, but before I do, I just want to follow up. I mean, the conversation we're having about Fed independence, I presume you can't unsee that, and that's something the next Fed chair is going to have to deal with. But more broadly than that, we've seen the president, is very interested in power, and has taken steps against other manner of institutions, universities, law firms, media companies. Does that, at what point, if any, does that begin to do markets have to stew on that? Is that something that markets are worried about here? How would we see it?
Well, I think markets have a way of sort of brutally cutting through to what the underlying impact on economics are, and it might be, I don't want to say good theater, but theater, right? And the administration going head to head with universities, but the impact on the broader economy near term and even intermediate term is probably not particularly significant. So I think markets right now are focused on immigration policy as it relates to the labor market, deregulation, which I think is actually the administration's secret weapon to promote higher levels of growth. We can debate whether it's good or bad policy, but it will be more pro growth if things are deregulated. And then you've got tariff and you've got taxes, right? As I think about like what happens in Congress or in the White House and how it might affect financial markets, I think those are the things that we've tried to stay focused on and try to in some respects just eliminate the noise that is easy to get wrapped up into.
Lael, final question to you. What keeps you up at night as we talk about all of these changes right now? What do you think are the biggest worries over the next 5 years for the U.S. economy?
Yeah, so on the first one, I do think it's that we're really testing the American exceptionalism, the kind of the really strong central role of the U.S. And the privilege that we get from that. And I do worry in terms of sort of financial instability risks that at some juncture we do get a really aggressive pushback because of a perceived erosion of some of those core underpinnings of U.S. exceptionalism, which include the independence of the Federal Reserve. And then more broadly, I think it is an erosion of our institutions longer term. I do think that, we've developed this system of scientific research which spans the universities, the federal government, and the private sector. It has made us the envy of the world, and I see that being eroded every day right now, and that will be to our long-term detriment and to the benefit of our rivals on the global stage, like China. And more generally, why do people invest disproportionately in the United States? Rule of law, strength of our institutions, just the resilience of our democracy. And I do worry that, it might be each individual change might on its own not be significant, but if we chip away at that, those institutional underpinnings might be really fundamentally weakened.
Well, I want to thank everyone for joining today's webinar. I want to thank our hosts at the Pissarro Center at Georgetown. And most of all, I want to thank you, Lael, and you, Joe, for participating.
Thank you.